Hello and welcome to BEC 5. In this module, we're going to talk about performance measures. So if I ask you, how do I measure the performance of an entity? You accountants, you're going to ask me to pick up these financial statements, look at the balance sheet, look at the income statement, look at a lot of dollar numbers out here to understand whether management, they've done a good job or they've done a bad job. But these financial statements, though they're pretty good, they have certain limitations. They are based on past events. Now, in the previous century, when we had companies based on physical assets, we had steel mills, let's say we had automobile manufacturers, machine tools. These financial statements, they worked very well with these corporations with tangible assets. But in today's era, the most important assets of a company are its people, its customer relationships, its innovation, what we accountants call intangible assets. Now, we think that because we've given it a name, we've dealt with it. But the name we've given is trying to define these assets by what they're not. Intangible means they're not tangible. When in fact, companies are spending millions and billions of dollars to enhance these intangible assets. They're training their employees. They're improving processes, they're developing products, improving customer loyalty. So when we financial accountants, we step in, we say, oh, this cost you money this period. It's an expense. You're worth less. When in fact, they're worth more because they are improving the capabilities which will drive value in the future. Now the logic, the problem here is that if you can't measure something, you can't manage it. So if you can't measure these very important so-called intangible assets, perhaps you aren't managing them. And that's your motivation to use the balanced scorecard. Now the balanced scorecard is a structured, comprehensive framework to measure all the important assets and capabilities that an organization has. Now we might not be able to measure all of these in financial terms. We might not be able to say how much is this person worth. We might not know how much is this product worth, or we might not have a dollar number for how much is your customer loyalty worth. Now that's difficult if not impossible. But now we're going to quantify all these using various non-financial measures. And as we measure them, we'll be in a better position to manage them and enhance our current and future capabilities. So the balanced scorecard framework is a strategic framework where we're going to use financial as well as non-financial measures to provide a more balanced view of organizational performance. So as I said, we are not only looking at the financial metric, the financial perspective, we are also looking at the customer perspective. We are looking at internal business process perspective, and we are looking at the very important learning and growth perspective. So balanced scorecard has all these four perspectives. So the financial perspective, this is the ability of an organization to provide financial profitability and stability or cost efficiency effectiveness. Customer perspective, this is the ability of an organization to provide quality goods or services, delivery effectiveness, and customer satisfaction. Internal business process perspective, this is the ability to have effective and efficient business operations. Learning and growth perspective, this is the ability of an entity to change and to improve. So we're going to look at all these perspectives. Within each of the four perspectives, we're going to define certain strategic objectives, objectives which the organization wants to achieve. And for the strategic objectives, we're going to have a performance measure. Guys, I told you, if we can't measure it, it'll be difficult to manage. So we're going to have performance measures for all these strategic objectives, which would be used to measure if the organization has been successful in fulfilling these objectives. So we're going to have baseline performance, which is the current performance of the entity. And then we're going to have targets. Now, there's going to be a difference between the current performance and the target. And to achieve the targets, do we have any strategic initiatives? So that is how your balanced scorecard looks. So you have your four perspectives here. You define strategic objectives, what you want to achieve. Performance measures, how do you measure if you've achieved it? you're looking at the current performance versus your target performance, and then do you have any strategic initiatives to help you get to your target? So let's look at a lot of examples that I've put on the board here. So under financial perspective, which is traditionally, we only looked at this. So let's say the strategic objective is to increase return on investment. How do you measure it? By looking at the return on investment percentage. So let's say it's 15% right now. The target is to get it 20%. How could you do that? Good way. Penetrate new markets. Good initiative there. Let's say you're looking at revenue growth. What's the performance measure? What's the percentage growth in revenue? Let's say you're looking at increasing profitability as your strategic objective. Then your performance measure, whether you have increased profitability, is looking at net income as a percentage of sales. That's your profit margin. So this was your financial perspective. Now let's move down. Let's talk about your customer perspective. Now you have a strategic objective to increase customer satisfaction. How do you measure whether you've done it? You're looking at customer satisfaction ratings. Let's say your current ratings are 82%. Your target is 98%. And you have a strategic initiative here. You want to launch customer loyalty rewards program, which would help you increase customer satisfaction ratings. Let's say under customer perspective, you also want to increase customer share. Now a performance measure here could be your revenue per customer. Your strategic objective, let's say, is to attract new customers, get new customers in. Your performance measure would be how many new customers did you get in, or what's your revenue from those new customers. Then we have the internal business process perspective. Let's say your strategic objective is to improve on-time delivery. How do you measure whether you've actually improved the deliveries? You're going to look at the percentage of on-time deliveries. Let's say your baseline performance is 75%, pretty bad. You want to get it to 95%. And an initiative that you've taken here is process re-engineering. You're going to re-engineer your process so as to make it more efficient, to ensure that you deliver goods or services on time to your customers. Let's say you have a strategic objective here to improve quality performance. How do you measure? By looking at the percentage number of rejections. Then let's move to our fourth perspective that we have here, learning and growth perspective. What's your ability to change, to improve, to move on with the times? So let us say a strategic objective here is to train employees on quality tools. How do you measure whether you've been able to train employees? You can look at the number of hours you've spent on training. So let us say this period you've spent 230 hours in training your employees. Your target is to spend 500 hours. Put them in training for many hours so that they learn how to use quality tools. And what's your initiative here? How do you plan to achieve this target? Get from the current level to your targets? You might have a training program redesign. That could be a good initiative. Let's say you got a strategic objective to use information systems to manage on-time delivery status. How do you measure whether this objective is achieved? You might look at the percentage of employees using these information systems. So these are ways where we are looking at a comprehensive picture of performance of an entity. Now, even within the balanced scorecard, this lovely framework, we could have a lot of cause and effect linkages which could help us create strategy maps. Think about it. So here we are looking at training employees on quality tools or using information systems to manage on-time deliveries. Now, if these are improved, these would help us to improve on-time delivery to customers. Yes, of course. So if employees are using quality tools, that means they'll be able to manufacture it faster. If they're using information systems to measure on-time delivery status, they would be able to deliver it faster. Now, these would help us to improve on-time delivery. Now, if we improve on-time delivery, this would help us to increase customer satisfaction levels. And naturally, if we are able to increase customer satisfaction levels, we would be able to increase our return on investment. We'll be getting more orders from our old customers. We'll be attracting new customers. So guys, as you can understand, there's a lot of cause and effect linkages within this balanced scorecard, and that's what makes it so much more amazing. On page 2 of BEC 5, we're looking at the balanced scorecard. Highlight strategic performance measurement. The balanced scorecard, it's got 4 primary perspectives: financial perspective, customer perspective, internal business process perspective, and learning and growth perspective. Now, all these are very important. Put a star there. The components of a balanced scorecard include highlight strategic objectives and underline objectives. Next, highlight performance measures and underline measures. Highlight baseline performance and underline current level. Highlight and underline targets. Highlight strategic initiatives and underline initiatives. So all these are integral components of a balanced scorecard. Move to page 3, where we're looking at characteristics of the balanced scorecard. Highlight strategy focused. Highlight balanced in terms of financial and non-financial measures, leading and lagging measures, as well as internal and external measures. The cause and effect linkages in the balanced scorecard identify which performance measures are highlight performance drivers or leading indicators, and which of them are highlight outcome performance measures or lagging indicators. On the previous sub-bullet, where we had leading and lagging measures, draw a bracket around that and point downwards. The leading measures, leading indicators, they are performance drivers. The lagging indicators, they help us measure whether a good job has been done. So they are outcome performance measures. Next, highlight strategy maps are diagrams that identify cause and effect relationships within the balanced scorecard framework. On the second half of page 3, we're looking at an example of a simple balanced scorecard. Put a box around balanced scorecard, highlight financial perspective, customer perspective, internal business process perspective, and learning and growth perspective. On the left, draw a bracket and write 4 perspectives. For each of these perspectives, we're going to look at strategic objectives and performance measures. Now let us identify certain cause and effect relationships within the balanced scorecard and build up our strategy maps. So let's say when we're looking at the learning and growth perspective, a strategic objective there is to train employees on quality tools. Now by doing this, naturally this would help us improve on-time delivery. So draw an arrow from here to the strategic objective under internal business process perspective, improve on-time delivery. Now, if we improve on-time delivery, naturally our customers would be more satisfied. So this would help us increase customer satisfaction, which is one of our strategic objectives under customer perspective. So draw an arrow up. Now, if we increase customer satisfaction, naturally it's going to bring us more revenues, more returns, more income, and it's going to increase our return on investment, which is our strategic objective under the financial perspective. So from increased customer satisfaction, draw an arrow upwards to increase return on investment. So as you can see, we can build up a lot of strategy maps within the balanced scorecard. Now let us understand leading versus lagging indicators. Leading indicators, they are performance drivers. Lagging indicators, they are outcome performance measures. So under learning and growth perspective, where we have hours of training on quality tools as a performance measure to train employees on quality tools, that's leading indicator. That needs to come in first. When you look at percentage of on-time deliveries under internal business process perspective. That's again, right, leading indicator. Now, if your leading indicators are in place, it would lead to improvement of customer satisfaction ratings. So customer satisfaction ratings, that is, right, lagging indicator. So improvement of customer satisfaction ratings, that would also help us increase our return on investment, which again is, right, lagging indicator. So leading indicators are performance drivers. They drive the performance. Lagging indicators, they help us measure whether performance levels have been achieved. Turn to page 4, where we have examples of many performance measures that could be included within the balanced scorecard. So put a box around performance measures. Now this is all pretty interesting stuff, and you could read this, review this as part of your homework. We just looked at the balanced scorecard as an important performance measurement tool. Now on the balanced scorecard, we used a balance of financial as well as non-financial measures. Now we'll move on and talk about value-based management, which is also called the financial scorecard. So as you can guess it, we're going to focus on financial measures here. So we're going to look at these financial statements and decide whether management, they've done a good job or a bad job. But the moment you pick up these financial statements, the first performance measure that you want to look at is profitability. How much has this entity earned? So the entity, they take in capital. So they get capital from debt investors, they get capital from equity investors. The debt holders, they get interest income. The equity holders, they get all the net income, the profits that the entity has earned. Now, debt holders, they've got a fixed interest rate. Even the equity holders, when they invested in the entity, they had some expected, some required rate of return. So all that put together, that gives us cost of capital. Now, if the entity only earns as much as its cost of capital is, it's done a good job, but economically, it's not added any value. Hence, we're going to use a concept called economic value added, or EVA. The question here is, how much has the business earned in excess of its cost of capital? That's the firm's economic profit. So let us look at the financial statements that I have here. I have the balance sheet and the income statement. Let's work through the income statement. So we're looking at sales, less COGS gives us gross, less SG&A would give us operating income. So we're looking at all the operating expenses. We're looking at COGS, we're looking at SG&A. Now on these operating expenses, we don't have depreciation and amortization. So this gives us to EBITDA, or earnings before interest, taxes, depreciation and amortization. From that, we're going to subtract depreciation and amortization, a non-cash expense, which would get us to EBIT, earnings before interest and taxes. From this, we're going to have less interest, gives us earnings before taxes. Less taxes gives us net income. So this interest expense, this is what you give back to your debt holders. Net income, this is what goes to the equity holders. Taxes, this goes to Uncle Sam, to the government. So, if we want to look at how much the entity has earned for both debt as well as equity investors, we want to look at EBIT. But of this, some portion goes out as taxes. So how about we don't subtract interest, we just subtract taxes. That gives us net operating profit after tax. Basically, what the entity has earned for debt investors as well as equity investors. So you have EBITDA less depreciation and amortization gives you EBIT less taxes. Now guys, there's a little glitch here. On the interest expense that we have for the debt holders, we get tax savings because interest is an expense allowed for tax purposes. But here, we would not have those tax savings in here in the net operating profit after tax. So we'll look at that in a moment. But for now, understand, we are looking at what has the firm earned for both debt and equity investors. And we'll call it net operating profit after tax. So we're going to have the operating profit here, less taxes. So operating profit into 1 minus tax rate gives us net operating profit after tax. Now we are looking at calculating the economic value added. What's the economic profit that the entity has generated? Now for that, we're going to have a formula here where we're going to say economic value added is equal to net operating profit after tax. So we're going to start with this number. This is nothing but operating profit into 1 minus tax rate. But what we said is, when the debt holders, they gave in debt, when the equity holders, they invested money, they already had anticipated some rate of return. That's the cost of capital to the entity. So from this net operating profit after tax, we're going to subtract the cost of capital to get to economic value add. What's the economic profit of the entity? So from this, we're going to subtract cost of capital. So let us say we're looking at the debt that we have here. So we'll have debt into cost of debt. We look at equity that we have here. So equity into cost of equity. Now, when we have debt, we said debt would have some interest payments. Interest payment would give us tax savings. What we would do is, when we are calculating the cost of capital, we'll adjust for taxes. So let us say if we have taken in debt at 10% and the income tax rate is 30%, we would say the cost of debt, that's not 10%, that's 10% minus 3% tax savings, 7%. So we'll have 7% here. So though we didn't do tax savings for debt here, we are adjusting it in our cost of capital. So net operating profit after taxes, all that the entity has earned for its debt holders and equity holders, less what they actually expected from us. If we give them more, that's when we have added economic value, EVA. Now that I've taught you EVA, let me also build up and talk about free cash flows from this concept. So when I'm looking at free cash flows, and let us look at what's the free cash flows to the firm. What we could do is, we could start again with this number. So we're looking at free cash flow to the firm. To the firm means both debt and equity investors. So we'll start with net operating profit after tax. And to this, we will add back depreciation and amortization because this one was not a cash expense. So if to net operating profit after tax, you add the depreciation and amortization, that gives you all the cash inflows that you had, the free cash flows. And then we're going to subtract any capital expenditure that we have done. So we're going to do minus any capital expenditure, investing activities, minus any increase in working capital because of the project. Would give us free cash flow that's gone into the firm. We could also look at free cash flow to equity, basically the free cash flow that is attributed to the equity holders. Then what you could do is, you could start with free cash flow to the firm, and then to the debt holders, you've paid them interest. So you could subtract, and we look at after tax interest. Because you'll be paying out some interest, and because you're paying out that interest, you're going to get some tax savings. So we look at after tax interest. So if 10% is the rate of interest and 30% is your tax rate, your actual cost of debt is 7%, not 10%. Because you're having an interest expense which is helping you save taxes. So you're going to do subtract the after tax interest. And then if you had taken more borrowings during the period, that would also be included in the cash flow which goes into equity holders plus borrowings during the period. Now, we looked at cash flow concepts when we did capital budgeting. We focused on free cash flow and equity, and now we know what's free cash flow to the firm, to both equity and debt investors, free cash flow to equity only to equity investors. But the most important concept that I wanted to get out here is economic value added, EVA. On page 7, we're looking at value-based management or the financial scorecard. Put a box around EVA or economic value add, which is equal to highlight net operating profit after taxes. So this one is right, operating income multiplied by 1 minus tax rate. Now from net operating profit after taxes, we're going to subtract. So circle minus and highlight cost of capital. Draw an arrow from cost of capital and write weighted average cost of debt plus equity. So when we're looking at economic value add, we're looking at economic profit for equity plus debt investors. So we're looking at the economic profit in excess of the cost of capital. Now put a note in there, note, tax savings on interest payments is not included in NOPAT, that's net operating profit after taxes. Instead, it is adjusted in cost of debt while calculating cost of capital. So the formula for economic value add is net operating profit after taxes minus cost of capital. Now, the tax savings on interest payments, we don't include it in net operating profit after taxes. Instead, we adjust it when we calculate cost of capital. Turn to page 8 where we have free cash flow, and right there, to the firm or FCFF, free cash flow to the firm, which is equal to net operating profit after taxes plus depreciation and amortization minus any capital expenditures and any increase in working capital. So put a bracket from net operating profit after taxes to depreciation and amortization, and right there, cash inflows. Draw a bracket from capital expenditures through net increase in working capital, and right there, cash outflows. So all the cash inflows to the firm minus the cash outflows, that gives us the free cash flow to the firm. And here we're talking about both equity as well as debt investors. Right there, free cash flow to equity or FCFE. So now we're looking at cash flows only to equity investors, which would be equal to FCFF, that's a free cash flow to the firm, plus net borrowings and minus after tax interest. We have an example here where we're looking at the numbers for Amartya Company, which has got net operating profit after taxes of $500,000, depreciation expense 125, change in net working capital 75, capital expenditures of $90,000, and invested capital, so in this case it's total assets minus current liabilities of $2 million. The weighted average cost of capital is 10%. So economic value add, that's the net operating profit after taxes minus the cost of financing. So that's $500,000 minus 10% into $2 million gives us $300,000 of economic profit, economic value add. Then you have free cash flow, and this one is free cash flow to the firm. So FCFF. So we're going to start with net operating profit after tax, add back depreciation and amortization, subtract any capital expenditures or net increase in working capital. So that's 500 plus 125 minus 90 and minus 75 gives us 460,000 free cash flow to the firm. We just looked at economic value added as an important financial measure that we use to measure profitability as part of a performance measurement. So economic value added, that was value added when we were looking at all the investments in the entity, debt as well as equity. Now let's look at another measure for measuring profitability, return on investment. And we'll start with an analysis which DuPont had done in the early 20th century. So what this said is, return on investment is return on sales multiplied by asset turnover. So when you're looking at returns on sales, we're looking at net income. So let us say if this is our income statement, we start with sales less COGS gives us gross margin, less SG&A gives us operating income. But since we didn't have depreciation amortization here, it came in here. EBIT is our operating income. Then you had less interest. So let me put the income statement back in place. So you have earnings before interest and taxes. You could call it your operating income. So when we're looking at net operating profit after taxes in economic value add, this is what we had taken. So we said this multiplied by 1 minus tax rate less the cost of capital, where we're looking at both debt and equity, is the economic value add. And then we had less interest gives us earnings before taxes, less taxes gives us earnings after tax or net income. Now, net income divided by sales, that's the return on sales. That's cool. Multiplied by asset turnover. Whenever it's a turnover ratio, remember to turn it over. So the denominator here would be assets. And we could say we're looking at average total assets. So total assets is this one. Average means beginning of the year plus end of the year divided by 2. So we got average total assets. So asset turnover, turn it over, denominator is total assets, numerator is sales. Now when you multiply them, sales and sales get crisscrossed. That leaves you with net income divided by average total assets. And this one is your return on assets. So they call it ROI, let's call it return on assets. So net income as a function of total assets of an entity. Now you could build it up further and get to return on equity. All this net income, this is for the equity stockholders. So all the net income, this flows into equity. So how much is the return on equity? So here you could look at net income divided by average total stockholders equity number that you have here. So two ways of looking at ROI, very important. So here we have looked at economic value add, where focus was on both on the debt and equity investors, and that is why we looked at net operating profit after tax. So this included the interest as well as the net income component. Here we are only looking at the net income component because our focus is what's going to the equity holders. Two very good measures of profitability. Now you could build up return on investment further and talk about residual income. So I told you, when equity holders, they are investing in the entity, they're not paid any fixed amount of dividends or interest, nothing, but they have some expectation in mind. They have a required rate of return. So residual income is what the entity has earned for them in excess of what they expected, what they desired. Again, that's like an economic profit for the equity holders. So something like economic value add, that was the economic profit for all the investments in an entity. Now we're looking at economic profit for, let's say, the equity holders. So when I'm looking at residual income, we'll start with net income that we have here, and we'll subtract required return. So let's put a few numbers from a book. So it says if sales is $200,000, so let me put numbers. Use a red pen here. So sales is $200,000. Net income, it says $20,000. Total assets is $100,000. Now in this case, what's the return on sales? That's 20,000 divided by $200,000, 10%. What's asset turnover? So that's sales by total assets. Sales $200,000 divided by $100,000 gives us 2. So 10% into 2 gives us 20% return on assets or return on investment here. Now, if you look at this number, net income divided by average total assets. So you have net income $20,000, average total assets $100,000. 20 by 100, that's again 20%. So we're good to go with this. Now let us say if cost of capital is 15%, let's assume we don't have any liabilities out here. We just have equity $100,000 for all the assets. So the cost of capital, it says, is 15%. So the equity holders, when they invested in $100,000 in the entity, they wanted 15% return, that is $15,000. How much did they get? They got $20,000. So net income $20,000, required return $15,000. The residual income, as we call it, is $5,000. That's the economic profit to your equity holders. Back on page 7, we are now talking about return on investment. So put a box around ROI. And right there, ROI may be calculated as, and the first option here is ROA, or return on assets. Highlight ROA. And that's equal to, right, net income divided by total assets. Draw an arrow from ROA to the DuPont analysis, where we are actually looking at return on assets. Now ROI may also be calculated as, right, or number 2, ROE, or return on equity. Highlight ROE, which is equal to, right, net income divided by stockholders' equity. Looking at the example that we have here, sales equals $200,000. Now there's an extra zero as a typing error, scratch it off. Average total assets equal $100,000 and net income is $20,000. So the return on assets here is net income $20,000 divided by average total assets $100,000 gives us 20%. Now the DuPont analysis calculates as return on sales multiplied by asset turnover. Return on sales in this case is $20,000 divided by $200,000, 10%. Asset turnover is sales by average total assets, gives us $200,000 by $100,000, 2. So the return on assets here is the return on sales 10% multiplied by asset turnover of 2 gives us 20%. Next, put a box around residual income. And let's look at residual income as, right, economic profit for equity investors. So if you are only looking at equity investors, we'll not look at operating profit, we'll look at net income. So scratch off operating profit and write there net income. So we're going to start with what's the net income, and from that we're going to subtract, circle the minus, and write there required return. So the return in excess of the required return, that is your residual income. Looking at the chart on this page, we got highlight net income of $20,000. Now let us say required return was 15% of $100,000 or $15,000. So put a bracket from $20,000 to $4,000 and write the required return. The excess of net income over the required return is highlight residual income. So in this case, let us say highlight cost of capital was 15% and highlight ROI, that was 20%. So this gives us highlight spread of 5%, which is our residual income, $5,000. On my board out here and on your book, we got the financial statements for Home Depot. Now, Home Depot is an American retailer of home improvement and construction products and services. So after you become a CPA and you have a lot of dollars in your pocket, naturally you want to renovate your house, you want to impress your girlfriend or your wife, and you would head straight to Home Depot adding to their revenues, adding to their net income. So now we'll analyze their financial statements and we'll look at a lot of ratios. We'll start with profitability ratios. So these are measures of the degree of success of the entity. How effective is an entity in generating profits from operations? Then we'll move on and talk about activity ratios. This is how effective is the entity in utilizing its assets. We also call them asset utilization ratios. We'll talk about liquidity ratios. So this is the measure of the entity's short-term ability to pay its obligations as they come due. We have debt utilization ratios. So these measure the effectiveness with which management finances the assets of the firm. This is used to evaluate the firm's financial leverage. And then we're going to talk about market ratios. So these measures consider the market value of the firm's common stock. So let's get back there, and I am ready, all armed with my board. Just fill in numbers, get the ratios out. So starting with profitability ratios. So this is the balance sheet, this is the income statement, profitability ratios, gross margin. So here we are looking at gross profit by sales. So gross profit is 18,108, sales is 58,247. This gives us 31.09%. Simple, easy. What's profit margin or net profit ratio? You're looking at net income, that's 3,664 divided by sales, 58,247. And this gives us 6.29%. Operating profit margin, it's simple. Gross margin, you looked at gross profit by sales. Profit margin, net income by sales. Operating margin, you're going to look at operating income by sales. So this becomes 5830 divided by 58,247 gives you 10.01%. Then you got return on assets. So that's net income by average total assets. So net income is 3,664. And guys, we're looking at average total assets. So we got total assets for year 1, year 0. We're going to sum them up, divided by 2. We're going to get 28,203. So return on assets is 12.99%. Return on equity, again we're looking at net income divided by average stockholders equity. So you have 19,802 plus 18,082 divided by 2. So that gives us 18,942. The percentage here is 19.34%. Then we got dividend payout ratio. Now this measures the dividend paid in relation to net earnings. So it says if Home Depot's dividend for the year was 22 cents, the dividend payout ratio is, so dividend per common stock, they're saying it's 22 cents. What's the earnings per common stock? So earnings per common stock is $1.57. This gives us a dividend payout ratio of 14%. Moving on, let's now look at the activity ratio. How effectively does the entity utilize its assets? So first we have the accounts receivable turnover ratio. Now for receivable turnover ratio, we need net credit sales divided by average accounts receivable. So average accounts receivable is 1,072 plus 920 divided by 2, that's 996. But the problem here is we don't have the number for net credit sales. We have total sales, and a lot of Home Depot sales are in cash. So we don't have the credit sales number. Let's assume, let's take the entire number as credit sales just for calculations, not in real life. So just for calculations, we'll take the total sales number 58,247. This would give us a very high receivables turnover because naturally, as I told you, a lot of this is cash. This gives us 58.5 1.48. A lot of receivable turnover happening because of total sales instead of net credit sales. Let's calculate the receivable collection period based on this metrics. So you have 365 divided by 58.48, that gives us 6.2 days of receivables collection period, because most of the receivables that I told you, most of the sales are being collected in cash. Okay, then we got inventory turnover ratio. So that's COGS by average inventory. COGS here is 40,139. Average inventory, so we're looking at beginning inventory plus ending inventory divided by 2. This is 7,532. The ratio here is 5.33. The inventory conversion period, so that would be 365 divided by this inventory turnover ratio 5.33, which gives us 68.49 days. So let's say around 68 days of sales lying in inventory. Okay, then you have fixed asset turnover ratio, which is sales divided by fixed assets. So guys, fixed asset turnover, denominator is fixed assets. Total asset turnover ratio, denominator total assets. Receivables turnover, denominator is receivables. Inventory turnover, denominator is inventory. So that's very clear. Whenever it's a turnover ratio, we turn it over. So a fixed asset turnover ratio, we do looking at sales 58,247 divided by the PP&E number that we have there. So we're going to use sales 58,247 divided by average PP&E. So we're going to look at beginning plus ending divided by 2. That's 16,272. This is 3.58. Asset turnover, we are again looking at sales of 58,247 divided by average total assets. So we have beginning total assets plus ending total assets divided by 2. The number is 28,203. The asset turnover is 2.07. Simple and easy. Let's move on. Look at the liquidity ratio. Does the firm have cash to pay its obligations as they come due? Let's look at the current ratio. So current ratio, we're looking at the current assets divided by current liabilities. So let's get back to the dashboard where we have our financials. So current assets, that's 11,917. Current liabilities, that's 8,035. So let's put the numbers. So you got 11,917 divided by 8,035 gives you current ratio of 1.48. Now we're looking at quick ratio. So that's the denominator remains the same, 8,035. But from the numerator, we're going to take out inventory and prepayments. So let's look at the inventory or prepayments number. So we got the inventory number of 8,338, nothing specifically for prepaid. So let's just subtract 8,338 from this total current assets. Let's get there. So 11,917 minus 8,338. So this calculates to a quick ratio of 0.45. So this is the acid test ratio. Next, we're looking at debt utilization ratios. So let's start with debt to total assets. So here we can look at total liabilities by total assets. So let's get there. We're looking at what's the total liabilities versus what's the total assets. So that would be 10,209 divided by 30,011. This is 34.02%. Debt to equity ratio. Okay, you could use your debt by total stockholders equity what we've done is we're using total liabilities by total stockholders' equity. You could use anything. Generally, the question is going to specify what you're supposed to be using. So let's look at total liabilities divided by total stockholders' equity. So we're looking at total liabilities 10,209 divided by total stockholders' equity 19,802. So let's put it there. 10,209 divided by 19,802 gives us 51.56% debt to equity ratio. Then you have times interest earned, so that's the coverage for interest, EBIT by interest expense. So earnings before interest and taxes, that's 5,830. Interest expense, that's 37. So basically what we're going to do here is EBIT 5830 divided by 37. That gives us 157.57 times. So EBIT is like 157 times interest expense. Pretty much covered. Now we look at market ratios. So these measures consider the market value of the firm's common stock. And the most commonly used ratio is price earnings ratio. So you're looking at the market price divided by earnings per share. Earnings per share was given as $1.57. Now it says assume that the market price is $34. So price by earnings. This gives us a PE ratio of 21.66 and we can call it X. Price by earnings. So price per share divided by earnings per share. Or you could look at market capitalization divided by net income. Then you have market to book ratio where you have price per share divided by the book value per share. How do you calculate the book value per share? Let's do that. So to calculate the book value per share, we're going to look at the total stockholders' equity, this number, divided by the number of common stock outstanding, this number here. So your net income divided by weighted average common stock, which gives you basic EPS. So we're going to divide this number, total stockholders' equity, by number of common stock outstanding to get to book value per share. So let's do that. So this is equal to common stock divided by, rather, let's say stockholders equity divided by number of common stock outstanding, which is 19,802 divided by 2362, which is $8.38 per share. So the book value per share is $8.38. Price is $34, book value is 8.38, gives us market to book ratio of 4.06. So the market price of each common stock is like 4 times the book value of each common stock. So guys, with this we've looked at all the ratios. We've looked at profitability ratios, we've looked at activity or asset utilization ratios, we have liquidity ratio, debt utilization ratios and market ratios. On page 11, we're looking at traditional financial statement analysis via a lot of ratios. Highlight liquidity ratios. Under that, highlight current ratio, that's current assets divided by current liabilities. Highlight quick or asset test ratio. That's your quick assets divided by current liabilities. So quick assets are your current assets less inventory, less prepaids. Or you could say they include cash, marketable securities and accounts receivable. Next, highlight activity or asset utilization ratios. And right there, remember, turnover equals turn it over. So when we look at highlight receivable turnover, the denominator is average accounts receivable. So underline accounts receivable. We've turned it over. Highlight inventory turnover. The denominator is average inventory. So underline inventory. Turn it over. Highlight fixed asset turnover. The denominator is average net fixed assets. So underline net fixed assets. Highlight total asset turnover. Again, you need to turn over total assets because your denominator is average total assets. Underline total assets. Next, highlight profitability ratios. So we looked at the DuPont return on investment analysis. Next one, highlight residual income. And if you're looking at residual income for equity investors, we'll not look at operating profit. Instead, we'll look at net income. So scratch off operating profit and right there, net income. So net income minus the required return, that gives you the residual income, the economic profit. Next one, highlight economic value add, where we're looking at the economic value added to both equity as well as debt investors. So we started with net operating profit after taxes and then we subtracted the cost of financing. We've already looked at free cash flow. Next one, highlight gross margin. So that's gross profit by net sales. Highlight operating profit margin. So that's operating profit by net sales. Next one, highlight return on assets and write the ROA. So this is something we got from the DuPont analysis, which was net income divided by average total assets. Next, highlight return on equity, write the ROE, which is net income divided by average stockholders' equity. Then you have economic rate of return on common stock. That's the total return. That's basically you're looking at dividends from the stock during the year plus the change in price during the year divided by the beginning price. So that's your economic return from the common stock or your total return from the stock. Move to page 12, highlight debt utilization ratios. Highlight debt to total assets. So that's your total liabilities divided by total assets. Next, highlight debt to equity ratio. That's total debt divided by total equity. Now from total debt, draw an arrow and write may use total liabilities. In this case, your debt to equity ratio would be total liabilities divided by total equity. Highlight times interest earned ratio. So that's your earnings before interest and taxes divided by the interest expense for the period. And finally, let's look at highlight market ratios. Highlight price earnings or PE ratio, which is price per common stock divided by earnings per common stock. Highlight market by book ratio, which is the market price of each common stock divided by the book value per common stock. Or you could be looking at the market cap of the entity divided by the book value of common stock. Now we're looking at benchmarking and best practices as performance measures. We've grown up with benchmarks. When we were small, our mom used to say, "Look at your friend, he's so obedient." And now suddenly we feel so insecure when a girlfriend talks about some other guy who's so much more caring or more romantic or more successful. All these are benchmarks. On page 20, we're looking at benchmarking and best practices. So benchmarking is the continuous process of comparing the levels of performance in producing products and services and executing activities against the best levels of performance. It is the search for and implementation of best practices. Now, benchmarking could mean that you write compare with, underline average performance results, circle or, and underline optimal results, which are best practices. Now, there are different types of benchmarking which include highlight internal benchmarking. And in this case, you're comparing underline similar operations within the organization. Highlight comparative benchmarking. Here you're comparing yourself with underline direct competitors. Highlight functional benchmarking, where we're looking at underline industry averages. And highlight generic benchmarking, where we're looking at underline overall averages of all businesses. Quality control, even that's an important performance measure. So we're looking at total quality management, which is managing the organization in such a way so as to achieve excellence in quality in all dimensions of products and services provided to customers. So you have ISO, which are series of standards established by the International Organization of Standards. So ISO 9000 series, here the focus is on the quality of products and services. ISO 14000 series, here the focus is on pollution reduction and other environmental goals. You have the concept of Six Sigma for quality. Here we improve the quality by identifying and removing the causes of defects or errors such that the defect rate falls to as low as 3.4 defects per million. You have a lot of quality tools and methods, continuous improvements, cause and effect analysis, control charts, mistake proofing. Let's get to the book and we'll look at all of this. On page 21, we're looking at quality control. Highlight total quality management, which is managing the organization in a way so as to achieve excellence in quality. It's also known as total quality control. Next, highlight ISO quality standards or standards established by the International Organization of Standards. Highlight ISO 9000 series, and here the focus is on underlying quality of products and services. Highlight ISO 14000 series, where the focus is on underlying pollution reduction and other environmental goals. Highlight Six Sigma quality, and this is about achieving perfection in manufacturing, which means underlying only 3.4 defects per million parts. Highlight quality tools and methods, and here we could look at highlight continuous improvement, which is continuous improvement of men, materials, machinery, methods, etc. Highlight Kaizen. Now this is a Japanese art of continuous improvement which emphasizes identifying and implementing underlying small improvements but on a continuous basis, as opposed to looking for major breakthroughs and big structural changes. Highlight PDCA or plan, do, check, act. So that's your order. First you plan, then you do it, you check it, you act. That's the Deming wheel, which focuses on continuous improvements underlying sequential or continual nature. Highlight cause and effect analysis, and highlight cause and effect fishbone or Ishikawa diagrams. Now these are used to systematically list or identify the potential causes of a problem or defect or an effect. So cause and effect analysis. Highlight Pareto principle. Now this is based on an estimate that underline 80% of all problems or effects come from only 20% of all causes. So here we're going to attempt to focus on the small number of significant big quality issues. Highlight control charts, and these help in underline detecting deviations or process drifts. Highlight Poka-yoke or mistake proofing, and underline making the production area mistake proof. For example, fitting guide rails on a machine which only allows the operator to operate it just one way, the way it is supposed to be operated. We all know that prevention is better than cure, and this is very true when we are looking at quality, especially cost of quality. Now, cost of quality can be addressed in 4 stages: prevention and cure. So the first we're looking at is preventive costs, which prevent product failure, which prevent bad quality. So here costs could include usage of high quality material, inspection of the production process, quality training of the employees, quality engineering and design, proper machine maintenance. So all these are costs which would prevent bad quality, prevent defect, failure of products. The next stage, we are looking at appraisal or detection costs. Now we detect the product failure before production is complete. So let's say we've inspected some samples of finished goods and we know there's some problem with the production process. Then you have internal failure costs. In this case, you detect product failure after production is complete but before it's shipped out to customers. Now here the cost of quality would include scrap or wasted materials. You might have to do a lot of rework costs to correct those defective goods. And then the last one, the most disastrous of it all, external failure costs. Now in this case, defective products, they are shipped out to customers. So now the cost to bad quality would include warranty costs, customer complaints, product liability. You might have a lot of sales returns back from customers. You might have lost sales because customers who've received defective goods this time, they may no longer want to order goods from you. And that would create a bad image of the company. So guys, as you can understand, we are okay with prevention. And this one is cure. External failure costs, they could be really disastrous. On page 22, highlight cost of quality. And here we're looking at highlight prevention costs and underline prevent product failure. Highlight appraisal or detection costs, which underline detect product failure before production is complete. Put a bracket around these, and these are generally looked at as costs of good quality. And then we have highlight internal failure costs and underline detect product failure after production but before shipment to customer. And highlight external failure costs, which is underline defective product sent to customer. So these failure costs, whether internal or external, these are, put a bracket and write costs of poor quality. So we are happier incurring costs for good quality rather than incurring costs of poor quality, because prevention is better than cure. Now we are looking at business process management, which is a holistic management approach which aligns an organization's business processes with the wants and needs of clients. Now, business process management attempts to improve processes continuously and can be described as a process optimization process. For example, let's say we are looking at HR, human resource functions like recruitment, training, employee performance reviews. Now, we could make these processes more effective, more efficient, and more consistent by incorporating business process management into HR activities. Now, in addition, business process management ensures that management has ready access to the information required to make important decisions. Now, let's look at the life cycle of business process management. So, it starts with design, where we design process improvements. Then it's modeling, where we simulate the process in a test environment and perform a what-if analysis. Then it's time for execution or implementation. Monitoring is tracking the process. And then you have optimization, which involves retrieving performance statistics from modeling or monitoring and identifying potential bottlenecks or other problems for additional improvement of the process. On page 23, we're looking at business process management, which is considered a highlight process optimization process. Now, business process management highlight promotes business effectiveness and efficiency while striving for innovation, flexibility, and integration with technology. The life cycle of business process management includes highlight design. We're looking at underline design of process improvements. Highlight modeling, where we're looking at underline simulating the process in a test environment, and underline performance what if analysis. Highlight execution, which is about underline implementing the new processes. Highlight monitoring, which is about underline tracking the processes. Highlight optimization, which is underline identifying potential bottlenecks or other problems for additional improvements of the process. Instead of effectively and efficiently managing their business processes, an organization may decide to put a box around outsource. So they could outsource domestically or internationally. International outsourcing, that's also called offshoring. Now, although there might be benefits, cost savings, tax benefit, etc. to outsourcing, such strategy may present additional risks. So put a bracket there and write risks of outsourcing. And they include quality risk, because the organization would now have less control over quality. There could be a language risk, which is specially associated with outsourcing across countries and across continents. There could be information security risk, where the organization may have to share confidential customer and company information. There could be an intellectual property risk, where information about the company's products and processes may get leaked out. There could be a public opinion risk, especially when there's international outsourcing, because you end up outsourcing jobs to other countries. There could be a social responsibility risk, where the organization needs to comply with ethics of organizations in other countries where they are outsourcing. Turn to page 24, where we're looking at other techniques that focus on improving processes. We could be looking at highlight business process re-engineering, which is about redesigning business processes to achieve underlying improvements in critical measures of performance. And we could be looking at cost, quality, service speed, customer satisfaction, etc. We could go for highlight lean manufacturing, where the operational strategy is to highlight achieve shortest cycle time. And we do that by underline eliminating non-value added activities and wastages and reducing incidental work. Make your manufacturing process lean. Next, highlight theory of constraints or TOC. Now, these are methods to maximize operating income when faced with some bottleneck operations. Highlight bottleneck resources are any resource or operation where the capacity is less than the demand placed upon it. And the objective of the theory of constraints is to increase throughput contribution while decreasing investment and operating costs. So highlight throughput contribution, which is underline revenues, circle minus, and underline direct materials cost of goods sold. And on the left, write need to increase. Then highlight investment, which is the sum of materials, cost and direct materials, work in progress, finished goods inventories, R&D costs, cost of equipment and buildings. Highlight operating costs, which include salaries and wages, rental expenses, utilities, depreciation. Now for investment and operating costs, put a bracket and write need to decrease. So the theory of constraints basically are methods to maximize your operating income even though you have certain bottlenecks. We could also do highlight workflow analysis, which is analyzing the overall flow of work so as to find ways of improving it. Now here we're focusing on achieving efficiencies by underline eliminating non-value added activities and underline improving coordination among various departments.